Beside me is footage of Warren Buffett's first TV interview in 1985. In it, he explains the habits and skills required to be a successful value investor. Now, Warren Buffett doesn't need much of an introduction. As CEO of Berkshire Hathaway, he's well known as one of the best investors of all time. But what I find most remarkable about his interview is that despite being recorded in 1985, his advice is just as relevant today. The interview is just under 7 minutes long, but there are 7 key lessons investors can learn from it. After the interview, I'll also provide some additional commentary on how you can apply these lessons for yourself. If you're new here and like this type of content, take a second to subscribe and enjoy the interview.
The first rule in investment is don't lose. And the second rule in investment is don't forget the first rule, and that's all the rules there are. I mean, if you buy things for far below what they're worth, and you buy a group of them, you basically don't lose money.
Warren, what do you consider the most important quality for an investment manager?
It's a temperamental quality, not an intellectual quality. You don't need tons of IQ in this business. I mean, you have to have enough IQ to get from here to downtown Omaha, but you do not have to be able to play three-dimensional chess or be in the top leagues in terms of bridge playing or something of the sort. You need a stable personality. You need a temperament that neither derives great pleasure from being with the crowd or against the crowd. Because this is not a business where you take polls, it's a business where you think. And Ben Graham would say that you're not right or wrong because 1,000 people agree with you. And you're not right or wrong because 1,000 people disagree with you. You're right because your facts and your reasoning are right.
Warren, what do you do that's different than 90% of the money managers who are in the market?
Certainly most of the professional investors focus on what the stock is likely to do in the next year or two, and they have all kinds of arcane methods of approaching that, but they do not really think of themselves as owning a piece of a business. The real test of whether you're investing from a value standpoint or not is whether you care whether the stock market is open tomorrow. If you're making a good investment in a security, it shouldn't bother you if they close down the stock market for 5 years. All the ticker tells me is the price. Yeah. And I can look at the price occasionally to see whether the price is outlandishly cheap or outlandishly high, but prices don't tell me anything about a business. Business figures themselves tell me something about a business, but the price of a stock doesn't tell me anything about a business. I would rather value a stock or a business first and not even know the price, so that I'm not influenced by the price in establishing my valuation, and then look at the price later to see whether it's way out of line with what my value is.
So Buffett chose to stay in this world, Omaha, Nebraska, where corn grows just minutes from downtown. Now, Omaha is a nice town, but nobody claims it's a world financial center. Here, the only thundering herd is actually on 4 feet. Don't you find Omaha a little bit off the beaten track for the investment world?
Well, believe it or not, we get mail here, and we get periodicals, and we get all the facts needed to make decisions. And unlike Wall Street, you'll notice we don't have 50 people coming up and whispering in our ear that we should be doing this or that this afternoon.
You appreciate the lack of stimulation here?
I like the lack of stimulation. We get facts, not stimulation here.
That's terrific. How can you stay away from Wall Street?
Well, if I were on Wall Street, I'd probably be a lot poorer. You get overstimulated in Wall Street, and you hear lots of things, and you may shorten your focus, and a short focus is not conducive to long profits. And here I can just focus on what businesses are worth. And I don't need to be in Washington to figure out what the Washington Post newspaper is worth, and I don't need to be in New York to figure out what some other company is worth. It's an intellectual process. Well, and the less static there is in that intellectual process, really the better off you are.
What is the intellectual process?
The intellectual process is defining your area of competence in valuing businesses, and then within that area of competence, finding whatever sells at the cheapest price in relation to value. And there are all kinds of things I'm not competent to value, but there are a few that I am competent to value.
Have you ever bought a technology company?
No, I really haven't.
In 30 years of investing, not one?
I haven't understood any of them.
So you haven't ever owned, for example, IBM?
Never owned IBM. Marvelous company. I mean, a sensational company, but I haven't owned IBM.
And so here is this technological revolution going on, and you're not going to be a participant.
Gone right past me.
Is that all right with you?
It's okay with me. I don't have to make money in every game. I mean, I don't know what cocoa beans are going to do. I don't, there are all kinds of things I don't know about. And that may be too bad, but, why should I know all about them? I haven't worked that hard on them. In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients start yelling, "Swing, you bum," from the stands, and that's very tough for people to do.
Warren, your approach seems so simple. Why doesn't everybody do it?
Well, I think partly because it is so simple. That the academics, for example, focus on all kinds of variables. Partly because
by academics you mean professors of
right,
finance?
The data's there.
In business school?
Sure, and the data's there. So they focus on whether if you buy stocks on Tuesday and sell them on Friday, you're better off, or if you buy them in election years and sell them in other years, you're better off, or if you buy small companies. There are all these variables because the data are there, and they've learned how to manipulate data. And as a friend of mine says, to a man with a hammer, everything looks like a nail. And once you have these skills, you just are dying to utilize them in some way, but they aren't important. If I were being asked to participate in a business opportunity, would it make any difference to me whether I bought it on a Tuesday or a Saturday or an election year or something? It's not what a businessman thinks about in buying businesses. So why think about it when buying stocks? Because stocks are just pieces of businesses.
Now that was an incredible interview, and one I think all investors should hear. Now, despite being over 3 decades old, Warren Buffett's advice still is just as relevant today. Starting with his first and most important rule for investing: don't lose money. Remember, it takes over a 100% gain to recover from a 50% loss. Buffett understands this concept, so instead of solely looking for opportunities that have high upside potential, he looks for opportunities that have low downside risk, i.e. situations where if you flip heads, you win; if tails, you don't lose much. If you can find several of these opportunities, then while you may have a few that don't work out, you won't lose much money, and the remaining winners can drive the performance of your portfolio. Buffett's second lesson was that investor temperament is more important than investor intellect. The great thing about investing is that anyone can be successful. You don't need a PhD or an Ivy League education to make money in the stock market long term. That's because your attitude is a much greater factor than your intellect in determining your long-term portfolio performance. Your attitude includes your level of patience, mindset, and temperament. Ideally, you want to be as objective as possible, looking at the facts, thinking logically, and not worrying about what the crowd or the market thinks. You wouldn't be emotionally affected by a short-term loss, and likewise, shouldn't be too excited about a short-term gain. But with a level-headed temperament, you can reevaluate the valuation of those stocks at that point in time and make an informed decision on what to do from that point forward. The third lesson, and the one that really helped Warren Buffett differentiate himself from other money managers, is that he has a long-term view which focuses on the business, not the stock. As an investor, the underlying business performance should also be your primary focus, as over the long term, the stock price will generally follow the direction of the company's earnings. Once you have evaluated both the business in its current state and what you can reasonably expect it to be worth in the future, then you can look at the stock price to see if it's trading at a discount to what you believe the business is intrinsically worth. If you look primarily at the stock price first, you may have a tendency to use that stock price to justify the business's underlying valuation and worth. For instance, if the stock price is high, rising, or increasing, you might inherently believe that the company is naturally worth more, even though price and value are not the same thing. As a value investor, make sure you're focusing on the business, and don't let yourself be too concerned with day-to-day price fluctuations, as most of that ends up just being noise, especially for an investor whose investments have a long-term time horizon. And speaking of noise, that actually gets to Warren Buffett's fourth lesson, which is to tune out the noise. Especially in today's world where we get so much information, whether that's from social media or other news sources, this overload of information creates a lot of noise that distracts from long-term thinking and reasoning. Now, this noise can come in many forms, including news articles, opinions on certain stocks or investments, and even just daily stock price changes. In determining what information is actually useful for helping making a long-term investment decision, you should ask yourself if this information will be really relevant to the business 3 or 5 years down the line. It's likely the vast majority of the investment information you're exposed to doesn't pass that test. By identifying and then removing that noise from your information diet, you're reshifting your focus to valuable information that can help you make a more informed long-term investment decision. Buffett's fifth lesson was to find and or develop your circle of competence. Your circle of competence being a subject area that matches your skills or expertise. For instance, if you've worked in the finance or insurance industry, you may have more insights and understanding on those specific types of companies and stocks compared to the average investor. Peter Lynch also calls this finding an edge when you're investing. You have to ask yourself, what is it that you know that gives you an edge over the average investor looking at that company? Now, this doesn't have to necessarily be a decade of experience within the industry, and could be as simple as first-hand experience or observations around the company or the products they sell. It's important to understand what you know and also what you don't know, because by veering outside of your circle of competence or investing in something that you really don't have any underlying knowledge about is one of the easiest ways to break that first rule of investing and lose money. So when you have an idea of what you want to invest in, it all comes down to Buffett's sixth lesson, which is to wait for the right pitch. In this baseball analogy, you're literally thrown thousands of pitches every day, as you can buy any stock on the market at the market price. However, if none of those pitches or investments look attractive to you at that current price, you don't have to swing or invest, and can wait until something looks exceptionally attractive to you. For instance, there may be some opportunities that come by that appear to be offering a reasonable expectation of 8% annualized returns. Those might be some fairly decent pitches to swing at and invest some capital into those stocks. Or you could wait for opportunities that offer an even higher potential rate of return. Again, it's up to you to decide when to swing, and the best value investors have the patience to wait for an attractive opportunity. And that gets into the seventh and final lesson Buffett leaves us, which is that value investing is hard. At its core, value investing is buying an asset at a price lower than what it's worth. That's actually quite simple, but it doesn't make it easy. You don't need complicated analytics, and you certainly don't need any technical analysis or other short-term indicators. What you do need to do is focus on the business first, understand what it's reasonably worth, and try to buy at a price below that. The investors who have the patience and temperament to achieve this end up doing quite well over the long term. Overall, I really hope you enjoyed the interview and were able to learn something from it. If you want more content like this, I'll leave a link in the description below of a playlist that includes more lessons from great investors. And definitely consider subscribing with the bell to be notified when new videos release. Until then, thank you so much for watching. My name is Michael, and I will see you in the next video.